right, we are live. Welcome everyone. Thanks for being early. We'll get started here in a few minutes. We got some more people tuning in. Thank you all for being early. It is February 9th, just after 11 a.m. We'll get started here in a minute once we are live on all platforms. Oh, looks like we're live with the chat as well. Here we go. Good morning, everybody. We'll get started here in just a minute. Good morning. Good morning. Give us a minute. We'll get live on all the platforms, and we'll get started in just a second. All right. Good morning, everyone. It looks like we are live on all platforms, so let me get started with the show. Thanks everybody for tuning in on the chat. If you have any questions, go ahead and throw them in the chat, and we'll pull those up a little bit later. Welcome everyone. My name is Nick Hiersche. I'm the president and founder of the Mortgage Calculator. Thanks for joining us today as we go over our daily rates live show every morning. I'm joined here with our sales manager, Jose Gonzalez, with 27 years of experience, who's going to go into a detailed example here a little bit later, and our COO, Kyle Hiersche, who will explain how to connect with our team and get your own quote that we're about to show here as well. And again, if you have any comments, feel free to drop them in the chat, and we'll try to get to those later. Before we get into the live rates for this morning, it is February 9th, just after 11 a.m. So the rates for all of our programs are live. We'll go through some basic examples. But after we go through our basic examples, we'll get into a detailed dive into a couple examples of non-warrantable condos. So this is another common term that's thrown around, some misconceptions out there. Hopefully, Jose, with 27 years of experience, especially in South Florida, where most condos are actually non-warrantable for various reasons, he has some solutions for borrowers who may need these non-warrantable programs. So we have a couple different solutions. Jose will explain some of those tips and tricks here in a minute. But again, it is just after 11 on February 9th. Let's get into the live rates for today. Let me switch to our pricing screen, and we will get started. All right, so this is our pricing tool. Again, please know that this is just the rates for today on February 9th, and this is just a live pricing tool for our mortgage professionals. So this is something that's for our team in order to get a pricing indication for today. If you would like a full loan estimate with a full quote, please get with our team members. We have over 300 licensed loan officers in 19 different states. We just got a couple new states this week. So please get with our team. We can quote those primary and second homes in 19 states, and we can do our DSCR business purpose loans in most states. So please get with us if you'd like a full quote, but let's check out what the markets are doing this morning. So we're going to set up a few standard scenarios here, and we're going to go through a standard conforming conventional example like we do every morning. The next best option typically is an FHA example, typically expands on our DTI and other guidelines as well. So typically that's the next best option for most borrowers. And then we here at the Mortgage Calculator specialize in non-QM and non-traditional financing, and those are found under our expanded guidelines program. So we'll go through a couple examples for that as well, keeping the same scenario the whole time. We won't go through VA. We appreciate our vets. If you do qualify for a VA loan, please get with our team. Since not everybody qualifies, we won't show those live rates this morning, but we can quote those in just a few minutes. And same with USDA. Not everybody is shopping in a USDA area. The property must be in a USDA eligible zone. So please, with our team, if you're looking in that area, we can quote those up real quick as well. let's go through our demo today. We're going to start with our conventional conforming programs. We're going to pull up our demo scenario. Is always going to be an 80 LTV loan with 20% down payment purchase. We're going to look for 99. What that means is 1 discount point in cost. So most of our clients are asking to buy down the rate a little bit since rates are a little higher than most people are used to. So most of our buyers are asking for this type of scenario. And we're going to do a purchase, 30-year fix, pretty common. Primary, single family, 1 unit, Miami-Dade, Florida. That's where our office is. And for all of our scenarios today, we'll use 760 FICO and a 40 estimated debt to income ratio in order to price out a basic scenario so we can check out the rates for this morning. So let's see what we have. Let me get through the security check. And as we do every morning, these top programs for Home Ready and Home Possible are specialty programs for borrowers under area median income or in a census tract. So those aren't for everybody. So let's cruise down to the first standard option, which it looks like the first standard conforming option is going to be this morning a 6.125 rate for 1 discount point in cost. So that's a great option for our conforming. Looks like it's a little bit lower than it was yesterday. That's again why we love doing this show every day, to check out the way the markets fluctuate in actuality on our live rate sheets for our live programs. So that's a great option for our borrowers that qualify for conforming. And we can go ahead and check out the next option, which is going to be typically FHA. So most lenders or banks will obviously go to FHA if a borrower cannot quite qualify for conforming for a few different reasons. FHA expands our guidelines a little bit and allows us a little more flexibility. So we'll pull up the same scenario, 80 LTV, 99 price, FHA. Everything else will stay the same, and we'll be able to compare our conforming with our FHA. So it looks like this morning the FHA 30-year best option that the computer found here. Oh, actually, this one would probably be the best. 5.5 rate, 5.5 rate for 0.75 in discount points here. So this would be the best option. And remember, FHA does have additional monthly mortgage insurance and upfront. So there is additional cost to consider. So always compare the APR on the FHA programs. In this case, it's 398. Sorry. So always compare those to get apples to apples. Now, what really gets us excited here that we love to do every morning are our expanded guidelines options. So many other banks and lenders do not have non-QM programs, but thankfully here at the Mortgage Calculator, this is what we really specialize in. So when we go under expanded guidelines, we have thousands of loan programs. Literally, I just looked at it this morning, 4,300 loan programs that we have beyond just the 2 or 3 ones that you just saw that are the typical options, right? So under expanded guidelines, we get a ton of options, but let's pull up this real quick to make sure it's the same scenario. We're going to do expanded guidelines, everything else the same, purchase, 30-year fix for a primary home, single family, everything else is the same, but you'll see when we click expanded guidelines, we now have more options for income verification. So instead of full doc, which we use for conventional and FHA, we have all of these other options, including 1 year, 2 year alt doc, asset related. We've done a couple shows on that. Business bank statements, 12 and 24 most common. Investor DSCR, we'll get into in a minute. And our personal bank statements is typically what we use for our show every morning just to check it out. This is our most popular non-QM option for a client who may not qualify with full doc for a conventional loan, but we can then use the personal bank statements, 12 bank statements for this self-employed borrower to determine their debt to income ratio. So if their debt to income ratio may have been too high using their tax returns and their full documentation, a lot of time our self-employed borrowers, we can determine their actual cash flow better by using their actual bank statements for their self-employed business and then determine a debt to income ratio. So for borrowers who don't qualify or maybe need to qualify for more, we use these alternative income documentation methods. And we'll see here the rates are very reasonable now, especially when we compare it to conventional when someone would not otherwise qualify. So our best program this morning is a 7.625 rate for our bank statement option for 1 discount point in cost. So a lot of great options we have here. And if you'll notice, there's dozens and dozens of different options here as I scroll down. And that's because when we're in non-QM, every program is very unique. So we have dozens of programs just under bank statements. So please get with our team to navigate which one of these may be the right program for you. Some of these non-QM options may allow things like bankruptcies, foreclosures, other credit events, and other specialty things that may be needed once we go outside of the conforming, conventional, and FHA guidelines. So we love to get these programs and offer our borrowers solutions where they might not otherwise qualify by using these great programs. Now, before we move on to Jose's example, we will always want to pull up a few investment property examples. So we love to work with our investors here, whether they're first-time investors buying their first investment property or investors with a dozen or 100 rental properties. We have some great options. So let's check out some investment property options for, again, pretty standard scenario, 80% LTV loan, 20% down payment. And we're going to compare our options here for a conventional investment property versus a non-QM investment property purchase. So first we'll check out our conforming conventional rates, and we'll keep everything else the same 760 FICO, 40 DTI, and we'll see what the investment property prices are this morning. So as I mentioned every morning, these investment properties do have an additional loan level price adjustment or cost from the government entities, Fannie Mae. So we'll see here a 6.625 rate, but there are no one discount point cost options. Right here, the best option the computer found was 3 discount points in cost for the 6.625 rate. So still some great rates in the sixes for investment properties. That's awesome for our borrowers and our investors that do qualify for that. Full doc, no problem. We can obviously quote this. But many of our investors ask for other options to go up in rate in order to reduce our discount points. So unfortunately, under conforming conventional, there's just not a lot of room here to go up in rate and go down in discount point. Looks like if that's the request, the best option we have here is about a 7.375 rate for 275 in discount points. So that's still high for some investors. So the next option makes a lot of sense when we go to our non-QM options, our expanded guidelines. For the same scenario, 80 LTV purchase under expanded guidelines. When we switch it to investment, we're going to have a few other options we can switch on here. So we can do an investment under all of these different income documentations, but the favorite program for once we're under non-owner occupied investment properties is our investor DSCR, which is only available for investments. And that is because it does not require any income verification. We simply use the property rents or proposed rents for a purchase in order to offset the PITIA or the cost of the loan. So we're going to cover the debt service coverage ratio. That's what DSCR stands for, in order to determine that that property can sustain that mortgage, that loan payment. And typically for our non-owner occupied investment properties, we're always going to add a prepayment penalty. That's pretty common for our non-QM programs. Of course, we can do a 0 prepayment option. That obviously is going to cost a little bit more. For all of our scenarios, we're going to price with a standard 3-year, pretty standard. And if you would like to get a 5-year, those options are available as well, and those will reduce the cost slightly. So we're going to do 3 years for our standard option. Everything else will stay the same, and we're going to check out our DSCR programs for our investors to not have to use any income documentation in order to purchase investment property. And you see here our best option that the computer found was an 8.25 rate, so a little higher on rate. Obviously, this is a non-QM program, but most importantly for our investors, we save the money out of pocket. Now we have 0.725 in discount points on this program, so we save, in our example there versus conforming, over 2 points in cost that they can then invest in other investments and rental properties. So these are great options as long as the property cash flows. You see we have dozens of DSCR programs with different variations. So please get with our team to find the one that may be right for you. As I always mention, some of these ones that you see with higher rates in the 9s and whatnot may be programs that we can use short-term rental income. So very common request, please get with our team. They'll find which one of these fits your purchase or your refinance the best in case you're using alternative types of income like short-term rental income to determine if you can purchase that property. So we'd love to work with our investors here on the DSCR program. Please get with our team, get the full detailed quote. I think Jose will probably have one option here in the example with the DSCR, but let's go ahead and introduce that. So give me 1 second. Let me switch over. And we're going to be going into our deep dive today on non-warrantable condos. So typically we do these with our expanded guidelines, aka non-QM loans. But Jose will go over a few different strategies to do it with a more standard loan as well. And obviously, I believe he'll have a DSCR example as well as a couple other examples. So Jose, why don't you go ahead and explain a little bit more, I guess, first about what non-warrantable is, since that's a common misconception, and then we can show your examples if you don't mind.
Awesome. Good morning, everybody. Jose Gonzalez, sales manager of the Mortgage Calculator. Thank you for joining us this morning for Daily Mortgage Rates Live with the Mortgage Calculator. Non-warrantable condos, and just especially condos in general, are very tricky because in a condominium, you are qualifying not just the borrower's credit and income, not just the property's value, but also the financial health of the condo association. That's very important because a condo is basically shared ownership. Everybody owns a little bit of the whole piece, and then everybody pays into the association budget, maintenance, and um, the whole collaborative effort that is a condominium ownership, right? So that presents several challenges when we are financing these properties because, again, we're not just pre-approving the borrower. That's fine and dandy. You do your pre-approval. Okay, borrower, you're pre-approved for X percent LTV, X purchase price, X down payment, all that good stuff. But then what happens when they go out on that property search? They find, the amazing condo. This is the one that I want. And then when you're doing the review of the condo, you find out that there are issues in certain of the parameters that are reviewed. Most of these condos are reviewed according to Fannie Mae guidelines. They sort of mirror the guidelines in a lot of the things that they look at. Factors like the budget of the association, the percentage of that budget that is held in a reserve requirement, the percentage of owners to renters, the percentage of delinquencies in the collection of the assessment. If one entity owns more than a certain percent of the development, and if the development is in litigation. So those are the main parameters that are reviewed that will make a condo warrantable, or if it falls out of spec with any or all of these parameters, depending where we're submitting this loan. But on a Fannie Mae, if it's a full review loan and any of these parameters are not met, then the condo is considered non-warrantable. It's not warrantable by Fannie Mae. So you're going to have issues. You can't put that into your package and sell it secondary to Fannie or Freddie. You have to figure out other ways to work this loan to make it acceptable. So there are a number of workarounds. Now, here in Florida, it's especially difficult because Florida, due to issues in the past with condos, Florida has totally different guidelines than the rest of the country for condo reviews. And this is real, this is evident in how we do the workaround. So the first option that we have for a workaround when we're doing these condos is called the limited review for condos. And I do have a quote set up for that option there. Now, this is probably going to be the best case option, as far as rate and as far as the combined loan to value. Because with this workaround, if it's a primary purchase, as you see if you can read what I wrote there, if it's a primary purchase and it's at least a 75% loan to value on the first mortgage, then Fannie or Freddie, I believe the same, the agency will allow a limited review option. What that limited review option means, that they will not review most of the parameters that would make the condo non-warrantable. So in other words, they won't review the budget, which is the main stumbling block on most of these scenarios, especially in Florida, where in many cases the association is not collecting enough in the monthly maintenance fee to put at least 10% of the annual budget into a separate reserve account, right? So that's a Fannie Mae guideline, 10%. So if we do limited review and that's not a question on the questionnaire, then guess what? That's not a factor. So they don't ask about the budget. They don't ask about the percentage of owners to renters. So they don't ask about the delinquencies in the assessment, right? The only thing they really worry about when you're doing a limited review is um, if one entity owns more than X percent, it's usually 10%. If one entity owns more than 10% of the whole, but the question is, does one entity own more than one unit? And then they answer, and it's usually if the answer is that that person owns more than 10%, then that becomes the issue. So percentage of ownership by one entity and litigation. Those are the two parameters in terms of questions that are reviewed. They still review the insurance of the building to make sure it's adequate, the property insurance, the fidelity bonds, the flood, all the stuff that they should have, but nothing having to do with the main financials that get these properties in trouble. So, and as an added bonus here, if this is a primary residence, you can combine this first mortgage with a HELOC, through a piggyback HELOC to reach a combined loan to value of 90%. So not only can we do the first loan at 75%, we add the HELOC so we can get to 90% CLTV. Now keep in mind this is for Florida because Florida has the restriction at a 75% loan to value for the limited review. The rest of the United States is 90% loan to value for a limited review. So this workaround that we're talking about is not necessary for any other state other than Florida. And by workaround, I'm talking about the workaround with the HELOC. The limited review is still the go-to option to resolve this. I mean, if you're going conventional, if you're going full doc and meet all those other parameters, and obviously a great option if you're outside of Florida. Inside of Florida, you may consider this option, or depending on the situation, you may consider a non-QM option. So this is for a primary. You see great rate, 6.5% at par. And then from there, you can buy it down all the way to 5.5%. So that is pretty good rates for a condo. Now that's primary. Now the same scenario, we can run it for an investment property. And in Florida, because our example here is in Florida, it's 70%. Now there is no, we don't have the piggyback option for this one, but we do have 70% loan to value for your investment property conventional, making it a limited review. The rest of the nation is 75% of the investment property limited review if you have any of these non-warrantable condo situations. And it's always good to reach out to the listing agent, up front, try to get as much of your information up front, get the budget. Normally the sellers have the budget, they have the annual report or the financial statements that they issue to them, which is usually the balance sheet and the budget. So make sure you get that so you can do your upfront work so it doesn't get you, off guard when you finally get the condo questionnaire, which could take 7 to 10 days, 2 weeks, or a little bit more. And usually that's going to come with the budget. And then if you find out at that time what you probably could have found out 2 weeks before, now you're running to try to resolve the situation. So again, this option here is investment, 70%, very good rates. Now we're going to go with non-QM options. For those scenarios that require non-QM option, could be your loan amount is above the conforming loan limits, for example, could be an investment property that they're buying in an LLC, because this is a full doc option that I'm showing you here, but this is full doc primary in this case. So you see rates here. This one is now 80%, which is another benefit here. We could probably go a little bit higher in the LTV, I think, on this one, but I did this at 80%, which is better than 75. So if you have the borrower that wants the higher LTV, doesn't want the HELOC, or for whatever reason has to go non-QM for the full doc option, very good option here. Now, when we are going non-QM, it's not really considered limited review when it's non-warrantable. So I did write a couple of uh, points here to consider. Um, so basically, with this option, it's possible as long as the project is 100% complete and no entity owns more than 25% of the project, and the project does not have more than 50% commercial space and has at least 5% of the annual budget in reserves. So again, a little bit more strict in certain ways than the limited review, but higher LTV and providing some of the other benefits that going non-QM may provide for you in the scenario where you could not go conventional for whatever reason. Because remember, non-QM is manually underwritten. So maybe you had a problem with your automated underwriting and you came over to non-QM. Here's your option. Now, going a little bit deeper, definitely non-QM, we have a bank statement option here for the same loan, same 80% LTV. Now we're going bank statement. The rate is only, I believe, an eighth of a percent higher. Let's look at the other one here. So this one was 8.5% at a $4,800 cost. And here, the same $4,800 cost gets us 8.625 using 12 months bank statements as income. So again, now it's getting really good. You can buy it down to as low as 7.625. So now when it gets even much better is our DSCR borrower. Again, all of these options are 80% loan to value. Yep. They're all 80% loan to value. And this is an 80% loan to value DSCR option, non-warrantable. Same parameters again. They're not going to go totally not looking at the budget for this. But again, at least 5% reserve and the 50% and all that kind of stuff. So as long as you meet no more 50% commercial space and no entity owns more than 25% of the project and the project is 100% complete, you can do this loan right here, DSCR. Again, now the rate only goes up an eighth of a percent higher. So mind you, here full doc was 8.5%, bank statement was 8.625, DSCR is 8.75. Now this is investment, obviously. The other options I was showing you were primary. So now we're going investment, DSCR, and we're only going up an eighth of a percent over the one that was primary and bank statement. So that should really tell you how they really love the DSCR. It's a totally different way of the investors, and here investors I'm talking about the secondary market. It's a totally different way how secondary looks at the DSCR loans. They actually like them because you're not looking at an individual here for the income. You're looking at the property, and I think they believe more in the property than in the individuals, possibly because the proof is in the pudding right here in how they are treating this DSCR option versus the primary full doc and primary bank statements. So 5 different solutions here for your non-warrantable option here, non-warrantable condos, and there are more. We could scour because we have hundreds of options, so we could scour them, but I looked through the one that probably would give the best rate options combined with the requirements. So looking forward to helping our team and our clients out there structure their non-warrantable condo purchases, and this is also available for refinances.
Beautiful. Thank you, sir. Well, we're right on time. Let's go ahead and let Kyle close it out and explain how we can get with our team to get your own non-warrantable quote if you think the project is non-warrantable. Go ahead,
Yeah,
Don.
absolutely. Thank you. So yeah, as you can see, Jose went through there quite the complicated process, and some of these deals are a complicated process, right? But we have over 350 loan officers from all around the country. And as Nick said, we're licensed in 19 states. And we can also do business purpose loans in almost every state. But you see, our loan officers are trained to not only be able to do conventional FHA via USDA, but they're trained to walk you through all of these different products, from the bank statement and DSCR loans that Nick went through on the quick pricer, all the way to actually being able to navigate through this world of non-warrantable condos as well. So definitely loan consultants that can help you. So if you have one of our loan officers you're already working with, maybe they shared this video with you, that's awesome. Go ahead and get with them and they can give you some personalized quotes within a few minutes. And if you're not working with one of our loan officers already, feel free to go to our website, themortgagecalculator.com, and we can connect you with one of them. You can also send us an email at info@themortgagecalculator.com. We'll connect you with one of our loan officers so they can start navigating you through the different programs that you may want to pursue. We do this every weekday at 11 a.m. Eastern, where we go through the pricing and then we do a deep dive into a different topic. So definitely tune in 11 a.m. Eastern every weekday. Everybody have a great day. We hope to see you tomorrow at 11 a.m. Take care.